Hi, Larry Berman here, and here's what's on my radar this week. Well, Elizabeth Warren had a scathing review for Jerome Powell in his testimony this week with Janet Yellen. As we all know, Powell is up for re-election, and we had expected by this point that Biden would already have nominated someone to take that role if it isn't Powell. And so expectations are that Powell will continue to have that seat, but to the extent that Warren has any influence at all, she called him a dangerous man, and not because of loose money policies driving inflation and the liquidity bubbles that are the financial markets these days and housing. But dangerous from the lack of regulatory oversight for banks. And we all know that she's a big proponent of clamping down on the banks. So, for us, we had trimmed some exposure this week to banks. Obviously, big rally in recent weeks. We were adding, and we recommended a couple weeks back, maybe a couple months back now, that we add towards the banks. The yield curve shouldn't flatten dramatically here, but we have noticed the flattening in the 5s to 30s curve, and banks don't fund themselves 5s to 30s, they fund themselves in the money market relative to the lending market, call it 2 to 5 year window. And in that part of the curve, there's been some steepening actually. We don't see the Fed raising rates or being able to raise rates. They may not get through full tapering by the middle of next year before equity markets have a fit. And we think part of the correction we're seeing now and the volatility we're seeing now in equity markets is in large part, the beginning of pricing in less liquidity in financial markets. The whole cap on treasuries in terms of the debt ceiling, that has not been resolved yet. We suspect they're going to try to throw the whole thing out, but it's unlikely going to happen this go round. I think we need a real fiscal disaster for Congress to act in that regard. That would require some pretty serious changes to legislation. So unlikely, although many are calling for, why bother? 100 times now you've had to raise the debt ceiling limit. Why not just forget about it? Well, that's probably not going to happen. So that's been a big challenge. So, I hurt my finger this week, home renovations, call it. And so I had to get a couple stitches there and probably ruin my hockey for the next couple of weeks and the balance of golf season, but first world problems. So I couldn't sleep last night. I was up very early, 6 a.m., saw the headline cross the tape that Merck has basically like a Tamiflu antiviral that in pill form that people can take that would mitigate significantly the ability once you have COVID, if you take it right away, to go to the hospital. And so, equity markets started to celebrate. As you can see in the chart here of the E-mini futures, the last 48 hours, big down move yesterday, right at 6 a.m. Overnight, we were down around 1%. Right at 6 a.m., we were probably down about 60 basis points or so. That headline hits, and slowly we start ticking up. Equity markets open, pretty strong. We get a retest of that headline level, and the markets have been ripping higher ever since. I think this is a counter trend trade. This isn't likely the beginning of a new move up here, although some think it is. I think the markets are going to be a lot more worried about less liquidity going forward, and the multiple needs to come down here. Have you noticed now for 3 weeks in a row, earnings outlooks have actually started to decline for the S&P 500 this year. First time in probably a year we've seen earnings outlooks starting to get downgraded. So as we get into mid-October, earnings season hits, we think there's going to be probably more negative outlooks than positive at this point. So we'll see how all that plays out. So bull and bear pick of the week. Again, we're still very, very cautious on equity markets. So that's our blanket caution that this isn't time to step in and get bullish. We do think reopening is going to be big. That's weighed against China slowing dramatically and China's ability to add stimulus here. The statement that we heard from China this week is that we're going to buy energy assets at all costs. Tells us that you got to keep buying dips in the energy sector. That's got to be one of the biggest positives there. And when that gets overbought significantly, then we start to trim. So we've rallied back close to the old highs. There's probably enough momentum left in the energy sector to break through those highs. Maybe 5 to 10%. That would be the next best selling opportunity in the energy sector to significantly reduce positions. But for now, we'll stay with that trade on the long side. Have a great week, everyone.